Hey, welcome to the live stream. It is Friday afternoon, Friday evening for some of you, and if you're in Europe, it is late Friday night. So hopefully the beginning of the weekend is a good one for you. It was a really good week for stocks. Stocks really went up this week, and I wanted to stream and just talk about the highlights that we had for this week. There's plenty to talk about. A lot of really good companies that are flying up, but some stocks are really being left behind. I don't think it's working for some stocks. So what I thought I'd do is I'd cover some stocks that look interesting, that in some cases are kind of obvious ones that are going up, and kind of just look at those. But I think there are some stocks that are very small stocks that are unknown that I think are going to make really good returns in the second half. I'm going to cover those and kind of give some of that intel over to the audience. If you're unfamiliar with the live stream, this is a place where we're just going to talk about stocks. And the perspective that I take is I'm a long-term investor, and I like to really understand what the business does and see if I agree with what they're trying to do over the next couple of years as a business. And assuming that's a positive, and then I look at fundamentals. I look at free cash flows. I look at how profitable a business is. Are they growing their top line revenue, which represents that that business is doing really well? It's getting more customers. It's raising prices. Those new customers are buying lots of their products or services. So that top line revenue really means a lot. Love having businesses that continue to grow because it shows that they're just the right company for the time. So I look at those fundamentals. I value stocks using a valuation technique that's been around for a long time by discounting future free cash flows and getting a net present value of those free cash flows. Over time, stocks will revert to that value of free cash flows. And if you haven't heard this expression, I'll state it, that this is Benjamin Graham's statement he made 100 years ago that Warren Buffett has repeated, and so has Charlie Munger repeated. In the near term, stocks are a voting machine. Investors vote for their popular stocks. Hey, I love Robinhood. It's going up. Okay, great. And investors will pretty much show their liking of that stock. But over the long term, the stock market is a weighing machine. It will weigh the profits and the cash flows. And no matter how popular that stock is in the near term, over the long term, they have to put up those profits and cash flows, or the market will realize what the company is about. Hey, it's a neat company, it's a popular company, but they don't make any money. And that stock gets sold off and gets forgotten. A lot of stocks don't make it over time. So it's a matter of being vigilant on one's portfolio. The second thing about, my channel is it's a channel made up of individual investors that manage their own investments and are really trying to take control of, their future wealth. And the stock market, if you watch, the big channels, CNBC and so forth, they want to convince you that there's these geniuses out there that can really, um, make you a lot of money. And I'm sure there's a couple of them, but most of them don't beat the market. And then investors have to pay them management fees on top of not performing to the S&P. So what's the gist of doing that? What's the long-term win in that? You don't make as much money. You're somewhat blind to what your portfolio is doing because a lot of those fund managers, they just do all kinds of things. So I do some homework on the best investors out there, and I try to put up some of the scorecard out there, who's doing great, who's not, try to learn some lessons from them. But then I take control of my own portfolio. I want to be able to know a good company when I see it, a good stock when I see it, a discounted stock when I see it. And I will cover that in this live stream. We'll cover a few stocks. If you're a member of the channel, put a stock symbol that you would like me to see in the chat and I will cover it. That's one of the perks of being a member of the channel. You can get signed up on the homepage. Just look for the join button If you're not a member but would like me to look at a stock, it's a $5 super chat. Be glad to take a look at a stock. Just buy a $5 super chat and I will be all over it. So let me review the stock market a little bit, just some highlights, and then I want to get into some stocks until I see some suggestions out there in the chat of some stocks to look at. So thanks a lot for joining. So the S&P did close at an all-time high, 6173. This is an all-time high, never been higher. And we got there at an all-time high earlier this year, February 19th. And we closed above that today by about 0.5%. So in my opinion, I think the market's going to go higher. We broke through that kind of ceiling, and now the market's probably going to run a little bit to the high side. That's my guess, right? All this is, everybody's got a perspective on it, and that's what I would say is out there. So looks like Mike is out there, and you want to look at AVAV and HWM. So I think AVAV is that drone company, AeroVironment, I believe. And then HWN, not familiar with it, but I will be in a few minutes when we cover it. Josh, good to see you. Happy Friday to you, sir. Sebastian, it's been a little while, man. Thanks for joining. Thank you very much for joining. Appreciate it. Yeah, so Mike, you agree that the market, now that we've gotten to an all-time high, it can run from here. And it's kind of good news, bad news. And the good news is stocks are priced high. So when I look at my portfolio, I'm like, all right, cool. Year to date, I'm up really nicely, making lots of money, making more money than I made last year. That's great. But there's a little bit of like sorrow in that thought, because I'm like, man, it's getting harder to find discounted stocks because I'm always looking for not necessarily what's working today, but what's going to make me money next month, next quarter, over the next 6 months, over the next couple of years. So that gets a little harder. But you know what? I'll take it. I'd rather have really high stock prices for the stocks that I own. It creates wealth for me, and I'm good with that. I am creating a little cash, but I'm not getting, carried away and selling like, half my portfolio. No, I'm just selling bits and pieces here or there strategically. It looks like Mike, Oscar is almost at a 52-week high. Yeah, I wanted to cover Oscar. Let's see here. And Oscar's just been an interesting stock because it's so volatile. It flies up, over a couple of days, and it drops. It flies up again. It's like, geez, man, what's it going to do next? I'm not sure, but the trend over the long haul, this stock looks really good, and I'll tell you more when we cover it. All right, so we've got some stocks on deck. I will cover those in a few minutes. Let me finish my thoughts. I wanted to cover a few topics. So S&P is at an all-time high. Crypto, $107,000 per Bitcoin. Where's that going to go? Interesting. Is it going to get up to like 150,000 per coin? I hope so. I own like 1.3 Bitcoin. So it'd be nice to see that balance go up. And over time, I am going to be selling my Bitcoin. I know that's kind of a unpopular statement to make, but mission's been accomplished with Bitcoin. It's gone up really nicely, and maybe it will go up to $1 million over the next 5 years, like Mike Stain. I hope so. That'd be great. But the mission's been accomplished for me. It's, I literally invested like 50 grand and it turned into 200 grand when it comes to Bitcoin. I've already sold, and I should say with crypto, because I also bought Ethereum, and I've sold all my Ethereum coins. I sold some of my Bitcoin, and I've got, I think 150,000 left or so of value. And I think I'm going to continue to sell, a little bit more to create some cash and see where it goes. See where it goes. And if it gets to $1 million, I still own more than one Bitcoin. So I'll be celebrating with you, Mike. All right. So Bitcoin is on the rise. US stocks just performed great. And you think about where we are, in the market. And Sebastian, you want to look at CPRX and United Healthcare. Yeah, we can look at those. So that's Catalyst Pharma and United Healthcare. So just thinking ahead, right? What potential negative stories can torpedo the market? I can't think of any big stories. I think the tariff scare isn't all that drastic anymore. I think when we didn't know what was going to happen, it was completely, a full blown, frightening kind of thought. Like, whoa, man, what if we get into a horrific tariff war? But I'm observing that, hey, China, US are beginning to, pencil out an agreement, and we're seeing some agreements be made. We're seeing that the president is not going to take the economy and completely, destroy the economy temporarily while he achieves his tariff objectives. He's not willing to do that, and I think that is what caused the market to say, okay, we can go up, because I don't think the president's going to take the economy down. He's just going to negotiate hard. The wars, the market is shaking it off. The new conflict with Iran and Israel, it's not affecting the market anymore. And oil prices have come down. So that's a big surprise. I thought they were going to go up. So as I look ahead, the Fed may reduce interest rates, which is going to help the market. The economy isn't doing great, but it's not doing terrible. So if the economy can just begin to grow some, that will help the market. If it continues to just sputter along, I don't think the market cares, because the market is rallying with the stocks that are making a lot of money. And those stocks are not going to stop making money. They're not going to stop growing. And we'll highlight some of those in this stream. All right, so let's keep going. Rotel and Cheese, good to see you. I'm going to keep rolling. I'll check on comments in a little bit. All right, so we've got the S&P doing what it's doing. I wanted to cover heat map. Looks interesting for today because there's some red and green, but I thought, hey, let's kind of look in the rear view mirror over the last month. And you see something that's interesting, right? NVIDIA has just been on a tear, just rolling over the stock market and saying, we want to be number one. And they are the most valuable company on earth, up 20% in 1 month. Incredible. Broadcom is right there. AMD up 30%. Incredible. Texas Instruments up 17. Micron up 33%. The semiconductor space is just on fire, just going up and to the right. Microsoft is up nicely. Amazon's up really well over the last 30 days. Banks, they want some. They're getting some. Citi up 15%. JP Morgan up 10%. So banks are making money. Looking at Google, it had a decent 30 days. It's got some ways to go because it's been falling behind these big, massive caps. Meta getting it done at 17% rise over 1 month. And Meta is on its way to become a $2 trillion market cap company. Netflix, 11%. Disney, really good month, up 11%. Nice job, Disney. In industrials, the defense contractors had a good month. GE was up, Raytheon was up, Boeing was up. So there's some green there. Energy had a decent month. It was up quite a bit for a while, and then oil prices came back down, so it kind of took some of those gains away, but Exxon was up 6%. And I'm beginning to see materials move. I'm going to show you an example of that later. So that's what's been moving over the last month. And as I look forward, Meta's not going to stop. I don't think Microsoft's going to stop. I don't think Amazon's going to stop. I don't know about semiconductor. Boy, they have had a really good month. Can it fade? It most certainly can, but it can continue to rally. Banks are going to do really well. The regulation on banks is getting lighter, so they'll be able to make more money because the reserves they have to hold are quite high coming out of the subprime market meltdown. There was more oversight put on banks where they couldn't make as many loans as they did before. And some of those limits are going to be removed. So banks can really do well latter part of 2025. So that's the heat map. Let's talk about sectors. Here are the sectors from top to bottom. Healthcare is doing well, materials, communication services. And I think these two at the top continue to be kind of an area of focus. I own the most investment in communication services. I own a lot of Meta, a lot of Google. I own Amazon, which has some communications in there. And I own Alibaba. So this category is like, that box is checked a few times. And I've got a lot of technology checked a few times. Financials, big. I don't own a whole lot of industrial. I own one or two companies. I own one staple company, but you don't want to own too many of those. And energy, I own two companies. Consumer discretionary, I own a few because that's where Amazon is, Alibaba, Mercado Libre, and others. So sectors, we're seeing a lot of green out there, and things are really, really working. All right, so I think there's one more list. This is the big caps, right? These are the bigs. There's a lot of green here. These guys have been moving the market. NVIDIA, as mentioned, they're just moving up. Year to date, up 17%. Microsoft's up 17% year to date. And Apple is down. That is, Apple has got no momentum. Amazon is in the green. Thanks to today's rise, they are now officially in the green, which isn't good enough, right? Their rivals are like Microsoft and Google. And Google is floundering. It's down 5.69. It had a good day, but it's got more to go. It's got to catch up. Meta's number one out of the big caps. They've had the best appreciation out of the big, massive caps. Broadcom up nicely. Tesla's bleeding red. So the three companies that are bleeding are Tesla, Google Alphabet, and Apple. Everybody else is making a really nice rise and making investors wealthier. All right, so let's jump into some stocks. Looks like Mike is in AMD. It's one of his babies. Man, I know you bring it up, and that's one stock where we agree to disagree on. And I'm glad you're making money on it. I am glad. All right, so the first stock, you may have never heard of this company, but they had a very good week, and that's AeroVironment. These guys do drones, right? So when you think about how warfare really has been fought for the last 20, 30 years, drones have been a big part of it. I think Ukraine had a successful attack of some airplanes over in Russia using drones. I'm sure there's a lot of drones being used, and these guys are a leader in that type of technology. They are aerospace and defense company, industrial, and the good news is they're doing really well. The bad news is the stock's up really, really high, and it really went up after their earnings. Their earnings came out very good earnings, and they're expecting a lot more sales for a couple of reasons. One of them is that countries in Europe for a long time were dependent on the US for protection. And now the US is saying, hey, we want you to pay your own way. And that might be a good idea. So those countries are going to have to buy their own military equipment. They're probably going to have to buy more stuff from AeroVironment. So the stock, man, geez, over the last couple months has gone from $111 a share up to $278. So this company's doing great, but man, chasing this stock's got to be tough, right? Now, if you bought back here, you're probably feeling like a genius, and you should, because you picked out a nice small cap. These guys are 12.66 billion after the big rise, and their revenue is $820 million. And the PE, geez, 179. Oh, that's expensive. That is expensive. I don't like spending high PEs, but we'll see. You'll see that their margins are not very good in a little bit. Forward P is 95. The analysts think, this thing's gotten too expensive by 19%. So let's get into their fundamentals. Now, before I jump into fundamentals, let me go over something that's important. That way you get my point of view. And most of you already know this because you've seen my live streams a lot. I'm looking for desirable companies, or I should say, I like to determine how desirable a business is and what kind of discount I'm looking for out of that business in order for me to, be an investor. In this example here, you got a really desirable business in Meta. They have great moats, great competitive advantages, keep competitors from taking away their market share of Facebook, Instagram, WhatsApp. Then you have a business that's terrible, like the Los Angeles Times. Their heyday was 50 years ago when newspapers really mattered, and advertisers would pay money to advertise in the LA Times. Their circulation was really high and all that good stuff. But now nobody buys a newspaper. This is a dying business. And I want a business, depending if it lands in the green, I'm willing to pay fair price just because I want to own that business. But if you give me a discount and it's a green company like a Meta, I'll buy. A Reddit, you bet I'm going to buy. In the gray, I want a substantial discount. I want a compelling discount. I buy stocks not because I'm a collector of stocks, like, oh, hey, I collected a 1966, Corvette and its original paint and so forth. That's not how I invest. I invest to make money. So in the gray, if you show me a company that's in the gray, and this might be a company that doesn't have as much profit, growth, and free cash flow, it might land in the green. And it might be a company that doesn't have a very strong moat, lots of competition. If the discount is good enough and the company is sound with a good balance sheet, I'm willing to invest if you give me a really good discount. So let's see where AeroVironment lands. So first, growth. It's looking good. Look at all these years of growth. That looks really good. So growth looks good. And in the quarterly, look at that growth, 39%. Man, a lot of drones were sold. Now, there was a little bit of a contraction in the quarter previous to it. So it may have been a combo that, hey, you see that they didn't sell much in Q2, which ended October 26, 2024. They had a contraction in the quarter that ended January 25th, 2025. So they had kind of a lot to make up. They had a lot of deliveries, I'm sure. So that looks really good, though. The market really liked it and the stock flourished. Overall, I think it's good growth. Now, defense contractors, right now, they're pretty popular. Remember, short term, stock market's a voting machine. Long term, it's a weighing machine. It's going to weigh profits, cash flow, and so forth. Well, these gross margins are not like NVIDIA, Palantir, Microsoft. They're lower because it's a defense contractor. Sometimes they have cost plus contracts that really limit their profits. So 39% is not terrible, but it's not good. It's not great. And their profit is 5%. They're not generating free cash flow. They're burning a little bit of cash. And look at that. They have not proven to be a cash flow generator. Now, I am sure the level of technology that has to go into a drone, robot machine, aircraft is immense. So they have to have a lot of engineers, a lot of software developers and so forth. And then they sell these devices. Well, the free cash flow kind of is scaring me away. I think AeroVironment is doing really well top line, but they're not showing me that they generate free cash flow. So I can't even generate a valuation based on free cash flow because it's negative. I can generate a valuation using earnings per share, but that's the minimum that I can use for a company. Let's see what analysts say about the company when we look at earnings per share. 7 analysts cover this company. One analyst think that it could go up a little bit more, but another analyst believes that it's really, really overpriced. And that overall, if you take an average of all their price targets, it's priced 19% too high. So we are in this year now. They just closed the year that ended April 30th, 2025. So we're in fiscal 2026. And they're expecting, wow, look at this revenue growth. They're going to grow 149% because they're going to go up to 2 billion. I think this is what the market's really excited about. They're going to expand their profits. So this is exciting for them. Happy for them. I know this company, it's a California company. They're up in north of Los Angeles. There's pretty good aerospace community, and that's where they used to land the space shuttle and stuff, in Palmdale and stuff. I believe they're up there. Now, this is going to be somebody else's investment, not mine, because this is going to be interesting for investors. But they're really buying into, you're buying into the story, but you're not buying on fundamentals, not yet. The free cash flow isn't there, and it should be there because they've been around for a little while. And I'm just afraid that we're going to get down the road a year or 2 years, and once this is over, maybe peacetime comes back to the world, and then the stock, the company goes from 2 billion down to 1.3 billion. The stock's going to really go down. So this one here is not a buy for me. It's actually I would avoid it. I would not buy it. I would sell it. I just don't see the fundamentals that are going to attract my capital. Let's take a peek at their balance sheet. Balance sheet isn't too bad. They have a little bit of debt. Once you deduct cash away from debt, $23 million of debt, no big deal. Really low debt. So this one here, I can understand, we're in a world where there's more conflict, and then the combination of our president is asking European countries to begin to build up their defense systems, and he's actually pushing for them for those European countries to buy American, products from the defense contractors. So I get that story. And you're buying into a story. That's not how I like to invest. I like to invest on fundamentals, and I'm going to stay in my lane. I'm going to stay on that lane because it's been working, and it's been working for a long time, and I think it's going to work for a long time. So those are my comments on AVAV. Interesting stock this week. Looks like Shadow Guy's here. How you doing? Yeah, I did mention that the rate cut may be coming, Shadow Guy, and I don't get overly wrapped up around rate cuts because the rate cuts maybe going to be a quarter, of a percentage, 25 basis points or 50, and that does change valuations, but it's not like, Meta goes from being worth, $800 a share to $20,000 a share. No, it makes it a bump of 5%, maybe 2%. And yeah, that makes a difference, but is it really, really compelling? Not to me, but maybe to others it is. All right, so the second stock is a little bit of a mystery to me because it's HWN, Hotwire Networks, over the counter. So Mike, you said HWN, right? I don't know that I'm looking at the right stock. So let me take a look at Mike's comment. So yeah, HWM. HWM. So Howmet Aerospace. So Howmet Aerospace provides advanced engineered solutions for the aerospace and transportation industries in the United States, Japan, France, Germany, and United Kingdom, Mexico, Italy, Canada, Poland, and China. Okay. They've been around for a while, 1888. Okay. Pretty big outfit. And I've never heard of these guys. So Howmet Aerospace. I mean, I've seen the pictures. They're making like components and nuts, bolts, and really high quality stuff. If it's going to go on an aircraft, it has to be good stuff. Yeah, they're making components. Yep. All these components go into, in this case here, the turbines that are being installed on airplanes. So they're a component manufacturer going into aerospace, defense and space. Okay. So they're a supplier to the big aerospace companies like the Boeings, the Raytheons, and so forth. Okay, so they're a $74 billion market cap company over the last year. Wow, 134%. Wow, they're doing well. Year to date, up 69%. This one is a winner, up 1,099% over the 5-year. Man, I've never heard of this company, but they're doing great. Good job, guys. $74.6 billion market cap. Revenue is $7.5 billion. So you're paying right about 10 times sales. PE is a little high, 60. Forward PE is high. Analysts again think it's priced too expensive, 21% too expensive. Here's the growth, and the growth is good, but it's not incredible. And they had a contraction in 2020. Maybe that was COVID. There was COVID impacts on civilian aerospace. You didn't have as many people flying, so you didn't have big demand for airplanes. So that had something to do with it. So maybe this is kind of a forgiven contraction. But then in 18, they had a severe contraction. That looks pretty severe. But after COVID, they've had a good growth trend, growing from 5.6 billion up to 7.5. All right. So they do have free cash flow of about $1 billion. They have gross margins of 32%, which are not great. For aerospace and defense, it's typical. But again, I can invest in aerospace and defense, which is very technology engineered focus, or I can invest in Reddit. And Reddit has like 80, 90% margins. Well, I'd rather invest in Reddit, or I'd rather invest in ALAB, or I'd rather invest in these companies that have these huge profit margins. So this one here at $1 billion in free cash flow, growing at about 10%. I could barely value these guys at 20 to 30 billion. And did I look at that right? I'm looking at the full year. Yep, full year. $1 billion. See, let's compare this. See, what does it take to run a business like this? Well, first, you're going to have a lot of intelligent people, engineers. This stuff's got to work. You got an airplane flying around with people in it. It just cannot fail. Really smart people work at these places. Got it. And really smart places work at places like Coinbase. Okay. And let's compare that to Coinbase. So really smart people work here as well. And when we look at some of the fundamentals, gross margin, 85%. Whoa. Well, these guys hired a bunch of engineers. They hired a bunch of talent, but they get to keep just gross, right? Gross margins, 85%. They take some 15% just to deliver the service that you use on Coinbase. Whereas the other stock, the other company, they have to spend 68% to deliver that product. Just a big difference. That's why I like companies like Coinbase. They just provide more cash flow, right? And when you look at free cash flow, 2 billion. These guys are already up to 2 billion. And what's their revenue here? These guys are 6.6 billion. And our friends over at this aerospace company are 7.5 billion. So this company's bigger than Coinbase, but Coinbase makes almost twice as much free cash flow. It's like, man, that one's easy. I'd rather buy more Coinbase. These guys here, their stock's really gone up. It's looking great. I mean, if you made the buy in this company 5 years ago, and keep in mind, 5 years ago, this is where I got to use a little bit of how did they get there? Well, I think it's because during the COVID years, this stock sold off so bad that, see, here's COVID. The stock was trading at 27 and then it cratered down because COVID just kind of affected their business. So the stock was down 50%. So when we do the compare, it is comparing to a very low stock price of $10. And now the stock's up to $174. Overall, it's still awesome, by the way. If you bought the stock back here, you're like celebrating. Good for you. But it's not a matter of, what it was trading for 5 years ago. Is it a good investment today? And for me, it's not. I'd rather buy other industries. This is just not floating my boat. Not enough cash, not enough profit. The stock's really bid up. And if we get some calmness in the world where you have, not as many conflicts, what happens to the stock? It's probably going to go down. It's probably going to torture investors that bought in too high. But if you bought this stock, congratulations. It's doing great. It's just doing too great. And the fundamentals, I find it hard to fall in love with industrials, aerospace, and defense because their fundamentals just don't look good. It's kind of an old school industry. And I'm like, no, man, I'd rather own Reddit, Meta, Google, all those really cool tech companies that make lots more money. So those are my comments there. And I'll move on to the next one. All right. So next one we're going to cover is Oscar, or wait, maybe I can go. I'm going to go with Catalyst Pharma. That was requested. And Catalyst Pharma, this company here, it makes very good profit. I'll show that to you in a little bit. This doesn't have a smooth chart. Overall, it's successful, 44.8. But you see how it just, it makes it really interesting getting there, right? Goes up and down, up and down. More recently, it's really had a pullback. We've had the stock really pull back, 17%. Now, there's no negative news that I'm aware of. According to Google, there's no news on that one, but maybe on Stock Analysis, there'll be some stories. So there's no like stories that say, oh, Catalyst Pharma, their pharmaceuticals are bad or something. They're a very small cap, $2.6 billion market cap, $534 million in revenue. So you're paying 5 times sales, which is reasonable. And has a PE of 13.89. That looks reasonable. Forward PE is 15. Analysts say it's a strong buy and it's discounted by 50%. Well, that looks good. So it's up. Is it up for the year to date? It's up 4% for the year to date. Over the 1 year, it's up 44%. It's had this really big pullback. Okay. Now let's look at their growth. Growth is excellent. 29%, 23%, 85, 52, 18. And although they're small, they're getting bigger. This is a really good takeover target for another business that's bigger than them. Let's take a look at, see, these are the kind of margins that I fall in love with. 83.5%. Who wouldn't like that? And these are, again, Like aerospace company hires a bunch of smart people. These guys have to hire a lot of smart people. They're in a different field, right? More biology, chemistry, life sciences and stuff. And they create pharmaceuticals that help people that have certain diseases or conditions. And they get to really flourish with high margins. And Catalyst has got really good drugs that are selling really well, working for people. And look at this operating profit, free profit margin looks fabulous, 36.9, free cash flow margin, 50%. Man, are these numbers make believe? Like Mickey Mouse wrote this story. And free cash flow, 269. Now that they're bigger, they're generating more free cash. So Catalyst for me has been a success story. And I'm glad you brought it up because this pullback's telling me that, man, maybe I should need to buy more Catalyst Pharma. Make myself a little note. Let's take a look at my valuation. And if you're a member of the channel, you get access to all my research. I put it on a shared folder and you get to look at it 24/7. You can see where I arrived on a valuation. I'm going to update this every month. Updated it mid-June, so I'll update it again mid-July. Catalyst Pharma is discounted by 46%. Analysts are saying 50%. And this one here is pulled back enough where it's like, well, maybe I need to buy a couple more shares. So far, so good on my investment with Catalyst. I'm doing well with the stock. It's gone up really well. And it has enough volatility because it's a small cap where it comes down and I could buy it at a better price and then, see it rise. Once the market realizes, man, the fundamentals are tremendous for Catalyst Pharma. Healthcare hasn't received as much inflows as like technology. Technology is excited about AI. It's excited about the data center. But I think it will. Eventually, money's money. Long term, stock market's a weighing machine. And when you weigh the cash flows that Catalyst Pharma is producing, it just amounts to so much value. And at the end of the day, we buy these companies, they produce profits. Those profits go in the balance sheet. And then we weigh that value and we arrive at the true intrinsic value of a company. And just Catalyst stands up tall. So I'm going to buy more shares of Catalyst. Thanks for asking. Those are my comments on Catalyst. Now, a stock that's been beat up, man, beat up is an understatement, is United Healthcare. This stock for a long time has flourished, right? But more recently, not so much. The stock had kind of gone sideways from 2022, and then more recently, just a lot of bad things have happened to the company. Year to date, the stock down 38%. But you're seeing that the market's beginning to pay attention, like, hey, this stock is moving up overall. This is a quality business. I've known of United Healthcare from an investor perspective for about 10 years. I've used United Healthcare insurance for more than 20 years. From those two angles, I could tell you this is a quality business. It's a quality company. Now, when I value the company, we'll just kind of skip to that, and then I'll come back to how I'm investing in United Healthcare. So what's interesting about being a stock investor, and I'll try to make this a little bigger because it's kind of small. There we go, it's a little bigger. It's discounted by 50%. So for a long time, I thought United Healthcare is priced fairly. And now it's been discounted because they lost their CEO. And previous to that, CEO was murdered, assassinated. It was terrible. But the business itself is the same business. United Healthcare is really, really good business. And when you weigh the cash flows they produce, it's just a really valuable business. So cash is worth 52% more than its current stock price. Earnings per share, 45%. So these are looking, this is looking like a really good opportunity. When we look at the way the stock market moves, is at times it's very irrational. It's nonsensical. It's like, why is the market doing that? And in this case here, you're seeing United Healthcare being sold off, but their core business didn't change. It's not like they're like, hey, we're not going to be an insurance company anymore. We're going to be doing restaurants. No, they continue to be the leading health insurance company in the United States. Continue to be very desirable for employers to use United Healthcare to provide insurance for their employees. So I'll show you a couple of examples of where the market just was nuts. Let's go with Meta, because that one's very well. One's kind of getting old, but I'll use it again, I guess. So for a period of time, Meta was counted out. Like, Meta's terrible, and the market was like, yeah, we think the Meta business should be priced down 76%. And I just shook my head and said, the market's nuts, totally nuts. And at a point, the stock started to rise, and it just did really well. This was obvious. Meta was worth a lot more than it was trading here. And I would say that when we talk about United Healthcare, I have the same feeling about this right here. And it's not just a feeling. I go to fundamentals, and the fundamentals tell me, yeah, fundamentally, this is when you weigh the value of this business, it's worth far more. So I'm buying United Healthcare, and I don't think it's going to take long. Part of the reason why it's not going to take long is I like to kind of keep an eye on what are these big investors referred to as super investors. What are they buying? Look how many are owners of United Healthcare. Some pretty reputable names. So these guys are in United Healthcare. This is a very investable company. David Tepper is in it. He's doing really well. Chase Coleman. So United Healthcare has a lot of credibility with big investors. Just right now, it's like, wow, people don't want to be in it because the assassination of the CEO that happened in the fall of 24, and then CEO resigned recently. Yeah, I get it. Those are real problems. But the core business was never affected. Those, unfortunately, the CEO that got assassinated, very, very sad. But the core business didn't change. When we buy businesses, we're not buying the CEO. The CEO is an important role, but you're buying the business. Okay. So all those things collectively lead me to believe that United Healthcare is going to pay off. I think we're going to get to a point where United Healthcare is going to be like a $700 stock, and we're there at $300. So in the next 2 years, it'll probably be a $700 stock. That's what I think is going to happen, and we'll see if I'm right or wrong. But the fundamentals are telling me, yeah, this stock really is worth over $600 today, and if they keep growing, it'll be worth $700. Might take a little patience, but we'll see how quickly it's going to do it. So thanks for asking about United Healthcare. It's good to see you. It's been a little while since I've seen you. I think it was Sebastian that asked, and very good to see you. All right, so I'm going to check in on comments real quick. All right, so I think I caught up with that. Josh, good to see you. AMD, we'll talk about AMD. Yeah, Nico Rucon, you agree with my comments on United Healthcare. Oscar is a really good opportunity. Oscar is small, okay? It's higher risk, but that stock could be worth 3-4 times its current stock price at some point. I'll cover that one a little bit. So Rotel and Cheese, good to see you. And then Factions Guru, good to see you. Shadow guy. Oh, so stock analysis showing future IPOs. Cool. Kind of like the way they show earnings. Broccoli high kicks. Yeah, good to see you. Thanks for joining. Thanks for all the chat. Actions Guru, Ben 10. Yep. Thanks for joining, guys. Thanks for joining. All right. And then Mike, I think there's some legal stuff around United Healthcare. There's always legal stuff when it comes to healthcare companies, health insurance companies. There's always tension there because politicians, it's one of their favorite punching bags, right? They want to show their constituents that they're making noise. So they want to say, oh, yeah, we know that you get frustrated with insurance companies. So I'm going to call them in and investigate them. And meanwhile, they're getting all these, political contributions from the same companies. So in a back room, they're like, hey, I'm going to make a bunch of noise, but in the end, you're going to be fine. That's my observation. Maybe you agree or disagree with that, but we'll see how that plays out. Let's talk about Oscar Health. Now, Oscar Health, now there's a movie coming out, F1, and my 20-year-old son wants to see it, so we're going to go see it. This is like when you watch the Oscar movie, it's a little bit like F1. There's going to be some wrecks. There's going to be some victories. There's some more wrecks and then some victories and, some really, really volatile, high speed, volatility. Overall, the stock's up 15%. And how's it doing year to date? It's up 51% year to date. And when this thing moves, man, it moves. One day move of 30%. I remember when that happened. It was like, I just shook my head because I was buying down here. It was great. And I shook my head because it's like, you show up to a dinner party and they're serving ice cream and cake. You're like, wait, you don't start dinner with eating ice cream and cake. That's not going to last long. So when they give me a 30% return, it's like I show up to dinner and they give me my favorite ice cream. At least it's my favorite. Okay, great. You're giving me what I want, but geez, man, can you just kind of like do that over the course of 3 months or something? Because one day is just unsustainable. And then you have another rise in the stock of 52% over a 7-day span. Of course, you have some really nice pullbacks at the same time, 21% over a 14-day span. So this one here, this is F1, Fast and Furious, that movie series. This one here is going to have a lot of thrills and spills, but overall, the stock is valuable. Let me show you the valuation on Oscar and tell you what I'm talking about. So in the near term, stocks are a voting machine. In the long term, we weigh the cash that they're going to produce and say, what's the net present value of that cash? And in this case here, it's a small company, higher risk. So I'm using a higher discount rate. And the value of all the cash that Oscar is going to produce based on my best forecast is $7 billion. I add cash with they have $3 billion of cash on the balance sheet. And they only have 300 million of debt. So collectively, once you add cash, take away the debt, the equity value of this business is almost 10 billion, but the market cap's 5.1 billion. So this thing, just when you weigh the value of these cash flows for Oscar, it's worth almost 2 times its current stock price. When you go earnings per share, it's closer to fair value. But this is the most respected way of valuing companies is based on free cash flows. If you look at my friend Scott's due diligence, he only uses free cash flow. If you look at the late, great Charlie Munger, he only used free cash flow. A lot of investors just use free cash flow. I like to look at earnings per share because especially with young companies, sometimes this gives us a very good lens into the business. This is a good business for me. I'm going to keep buying Oscar Health stock. I'm doing well with it, and I think if this thing works, this is easily going to be a 5-bagger or a 10-bagger if it works really well. So I want my ticket to see this movie all the way through, and hopefully Oscar. The other things that I like about Oscar is the guy who runs Oscar. He ran one of the big health insurance payers, Aetna, for a long time. Now he's running Oscar because he believes that what's the mission statement of the company? In the United States, if you work for a big employer, you're going to be insured through like United Healthcare, one of the big, companies like Elevance or, whomever else, Humana. Now, if you're an individual, let's say you are an entrepreneur, you drive for Uber, or you have a very small business. You're a plumber and you're like, hey, I work as a plumber and I have 2 employees, 3-person outfit, but I want to provide healthcare for those 2 employees and I want healthcare for myself. That's exactly what Oscar Health is going after. And that population of people is massive in the US that don't have access to a big employer like a federal government agency or a big employer to then get their health insurance through. So these guys are trying to take over that very fertile market, do it very well, make a lot of money, provide everybody wins. The customer in that market is going to have access to insurance through a very reputable name. The big insurances like Elevance and United Healthcare, they don't want to touch this part of the market. They'd rather sign a customer that has 150,000 employees and they get this massive contract and they get immediately a population increase of behind their healthcare of 150,000 insured people. They don't want to touch this business, and Oscar can kind of take over. It's a very fractionalized business. And I think the reason I say that is the addressable market that Oscar has in this space is huge. They can continue to grow at fast rates for a long time. They're already catching attention of some investors, 54% growth, and they're already a $10 billion revenue company. Well, if they keep growing at 50%, maybe get to 20 billion in revenue, and they keep growing at those rates, you better believe a lot of super investors and a lot of people are going to get into the stock. So I really like the top line revenue growth shows me customers like Oscar. People want to go get their insurance there. And they produce the cash flow that substantiates the valuation of the company. They have a great balance sheet. They have very good leadership. And the business idea is a good one. I believe in it. So I'm a buyer of Oscar Health. It's been a fun stock to watch, man. But it is not going to be a smooth ride. It's not. It's going to be a ride where you're like sitting on the stock price of $23 a share, and then it goes down to, I don't think it's going to do this again, but it went down to $11 a share. Oh, man, brutal. But you got to be smart. Buy at the right times. Buy here. Right now, I think it's a little overheated. This came up in the investor call on Wednesday. And man, it's so hard to predict Oscar because on Wednesday night, we're talking about it. And I'm like, man, Oscar's such a tough stock to buy into because it just goes up so fast. I think currently the stock is just a little too expensive. And then the very following day, it went up 9%. So it's like, yeah, it's a hard one to predict. So that's Oscar Health. Thanks for asking about Oscar Health. It's a fun one to cover. And hopefully it's a big money maker and it has a lot of entertainment value at the same time. So Mike, you're only up 45% on Oscar. I think, so I guess two things that come up on this live stream. First, Bitcoin may go up to $1 million a coin. You'd be celebrating that, I'm sure. Second is if Oscar goes up 5x or 10x, is what I said. That'd be awesome. And it most definitely is possible. I think, again, if Oscar stays on the path that they have communicated, I don't see another big competitor that's stepping in right now and kind of going to face off against them. And if they grab a lot of that market share and they become the trusted brand for that individual or small business, it's just going to really, really work, because this is a business that just is profitable and generates cash. It's proven. United Healthcare proved it for a long time. I made a lot of money on United Healthcare. I sold it before all the latest and greatest carnage, but it made me a lot of money. So I can tell you firsthand that these insurance companies are really good investments over the long haul. Speaking of good investments, we're kind of on the exciting side of the stock market. AMD. Now, AMD has not been an investment that I've made. I just don't think their free cash flows, and I'm going to show that later, it just doesn't get me to invest. Now, recently, the stock's really done nicely, up 30% since May 30th. Nice. So in less than a month, this one's really, really moved. So congratulations to AMD stockholders. Year to date, up 19%. That's really good. And if you look at the trough that we saw just this year, when we saw that big sell-off in April, this stock's moved up 83.88% since that dip there. Amazing. So congratulations to you guys. Now, this one hasn't been like a super compounder, right? The market really bought into it when they were buying into NVIDIA, but then it kind of really sold off quite aggressively, 57, 58%. And when we look at NVIDIA, now, I'll say this a lot of times, and it's not meant to bug you or kind of wear out the statement, but it just means it. I really believe this, which is investing, and I'll show it through here. There's no rule that says you have to buy Apple or you have to buy J&J. And within a space like semiconductor, there's choices. You can buy NVIDIA, Broadcom. I've invested in Broadcom, made money on Broadcom. I missed on NVIDIA. You can buy AMD, you can buy Qualcomm, Texas Instruments, Micron, Intel, if you want to buy that dumpster fire. And so my point being, okay, there's a variety of choices. So I like to compare the fundamentals that are available, because I'm going to invest on fundamentals. So we're going to have a face-off, AMD versus Qualcomm. AMD has a market cap of 233, okay? And revenue is 27 billion. So you're paying about, is that about 9 times, 8 times, yeah, about 8 times revenue. Not too bad. PE is high, 105. Forward PE, 35. Now, some news stories have come out that AMD GPUs are beginning to not necessarily be better than NVIDIA GPUs, but are being somewhat compared to the performance that NVIDIA has. That's really good news, because if they can compete in that market, it could be a growth catalyst and a profit catalyst. But that's right now a story. We got to see evidence of it in their financials. We got to see evidence of it. Growth is good, 21% the trailing 12 months, 13% in full year 2024. That's very good. They had a little bit of a contraction in 2023. These guys have margins of 53%, which is much lower than NVIDIA. NVIDIA has like 85%. And the free cash flow, 2.7 billion. which isn't incredible, by the way, because they have a big amount of revenue. What's the margin? Excuse me, the free cash flow percent. Free cash flow margin, 9.9%. That's not terrible. It's not great. Somewhere in between. And when you have a valuation like AMD has, it should be great because they have a big valuation. Now, again, we don't have to invest in AMD. It's not the only semiconductor company that exists in the world. No, there's lots of them. And Qualcomm is the one that I found has the best fundamentals. So Qualcomm has a lower market cap, a higher revenue amount. So you're, whoa, hey, I'm paying 4.5 times sales. I had to pay a higher price of sales on AMD. PE is 16. Whoa, AMD was at 100. Whoa, this is much lower. This pays a nice dividend. Analysts think it's discounted. Growth. Growth is in the same ballpark percentage-wise as AMD, but the revenue amount is higher. So they're actually growing from a dollar perspective in greater portions than AMD. Margins, 55%. So it's about the same. Free cash flow, 11.7, where AMD was at 2.7. So you're getting about 4 times the free cash flow amount out of Qualcomm. That's a big separation in value for me as the type of investor that I am. And you look at these, look at the free cash flow margin, 27.68, AMD was below 10. So for me, Qualcomm is the investment I'm going to go with. AMD is interesting, it's exciting. I hope it works for Mike and anybody else who's an AMD. But for me, the investment on an established semiconductor company is Qualcomm. And AMD, we'll see where it goes. We'll see where it goes. If I'm going to dabble with, hey, there's a story out there in semiconductor that I'm excited about, I'm going to go with Astera Labs. And this one pulled back nicely today, 7%. But these guys are growing at 200%. Semiconductor company with a unique proposition in the market that I think their proposition really makes a lot of sense. And this one here, I believe, is still discounted, but it's just talk about, you know, how we talked about these stocks really make it interesting to be an investor. A-Lab most definitely is going to give you, it's going to give you a rough ride. It's going to be like that F1 race where the stock just jumped 280% within 4 or 5 months, and then it tanked. But it's a high growth stock, so I bought in here, and now the stock is just booming, up 65%. And I think A-Lab could be a 5-bagger. This is, you can't find a lot of companies growing at 200% that have a legitimate marketplace. Like they have a legitimate technology that is in high demand. Wherever NVIDIA goes, this one's going to go because it's really a necessity for data centers. And when we look at Astera, some of the things that I didn't like about AMD, gross margin 75%, AMD was at like 50. Free cash flow margin, these guys already produce free cash flow. It's just naturally, this is a valuable business in my opinion. So that's going to be my combo for semiconductor is old school, put my money in Qualcomm, new school, exciting A-Lab, and just watch A-Lab go. Because A-Lab just is, get your popcorn out because this thing goes up and down. And you see that it's year to date's losing money, but it's not about year to dates. Like, where did you buy it? If you bought it at the right time, you're up 71%. So buy stocks at the right time. Easy as that, right? Well, if you do your homework, you could wait for a company that you really believe in, that you think these guys have the right business. They were just overpriced, but now the stock market's lowered the price to where I think it's a very good investment. And boom, you seize the opportunity. So that is A-Lab. Go A-Lab. All right, so we're covering a lot of ground. We covered AeroVironment. We covered HWM. So we went into defense contractor names, Oscar, United Healthcare, Catalyst Pharma. Made myself a note to buy Catalyst Pharma. Gotta make sure that ends up on my spreadsheet. AMD, we talked about Qualcomm, A-Lab. Man, it is so fun to invest in stocks. That's why I do live streams. That's why we, have the Discord and we talk about stocks pretty much, throughout the week. And it's a really, really fun process. And it's even funner when you're making a lot of money. So, it's fun to interact and try to find that next stock that's really going to work. And we'll see how it goes. So Ben 10, you had Oscar Health. It sucked. Yep. Like I said, if you buy at the wrong times, it most definitely sucks. But if you buy at the right times, it definitely rules. It definitely rocks. So, all right. So it looks like Mike's having dinner. Shadow Guy. Good to see you guys. All right, guys. So how long we been streaming here? A little over an hour. Cool. Saeed, how you doing, buddy? AppLovin, how expensive is it? Let's take a look. AppLovin's been kind of getting beat up a little bit. I've seen it go up and down. Let's take a look at it. I know I have a valuation on it, and we'll take a look. So it was down today, year to date. See, it's 3%, but look at this volatility. This is not a small cap. What's their market cap? 112. So it's not a small cap. 1 year, 300%. And what this company does, they develop software that helps marketers online. So when they're putting their marketing dollars to use, and this software will put their ads, on Reddit, Facebook, Instagram, YouTube videos, Netflix. Now that they have a ad model, Amazon with their Prime, so they're kind of giving you the best return on investment marketing wise by using their software, using their platform. And it is a very good idea for these marketers. So that whole, service is what AppLovin does. Totally makes sense. They're the leader. Now, they have been shorted by a couple. I think this short was caused because I forgot who did this, but they were bad mouthing the company, saying they have some shady practices on violating the privacy laws that we're supposed to have these privacy laws that they're not supposed to use our private details to then use them and then market to us. Well, these guys get around that and are able to market to people, even though they have said, no, I want my privacy to be secured. So that was put out there, and I think that's what's caused this sell-off. Now let's take a look at fundamentals, and I do have a valuation of AppLovin. So AppLovin, $113 billion market cap, revenue is $5 billion. So you're paying 26, 27 times revenue. That's expensive. And then PE is 60, expensive. Analysts think it's discounted. Now, it's expensive unless the growth is really good. And in this case here, 41% growth. It's very good. That's solid. That's a pretty big number, 5.1 billion. So revenue looks good. Quarterly, right there with 40%, looks good. And when we look at the margins, this is a software company, right? So 77% margins. Hello. That's a good looking margin number, 77%. Free profit looks good. Free cash flow margin, look at that. Jeez, man. Is it legal to make this kind of profit? It certainly is. That's why you want to have a software company. That's why you want to have like a Facebook-like company. So these guys are making a lot of money, very profitable. Their balance sheet's very good. From memory, I think they have a lot more cash than debt. And My memory failed me. 551 million in cash, and they have $3.7 billion in debt. When I look at debt to EBITDA, it's 1.31, which is acceptable. I want it to be lower than 3. So very good revenue growth, showing that customers really like the software. They're growing really fast. Great. Market's really excited about it, up 300% for the 1 year. Okay, now let's see what my valuation on AppLovin. That is Apple. Okay, AppLovin. So right now I think AppLovin is priced a little expensive. When I look at their cash flows and I look at how those cash flows are going to grow, and I give them a discount rate of 8%, that could be 8.5 or 9, but they're fairly priced. Now, it's a type of business where they don't have a super strong moat, and the reason for it is Meta could change their policies on how they allow advertising, and it could really hurt the AppLovin business. Same thing with like Amazon and YouTube by Google. And I think that's kind of a piece that I'm like, well, I'm insecure about that. I like software companies that are kind of in control of their own destiny. And I think AppLovin will always be have to comply with how these big powerful companies, Meta, Google Alphabet, Amazon, Netflix, how they want them to advertise. So having said that, that's not enough discount for me to be an investor. I'd rather sit on the sidelines and just see this thing play out. Now, if AppLovin were to sell off, let's say this stock went down to like $250 a share, yeah, I'd be a player. I think I'd probably get into AppLovin. And I'd like to see a little more on this controversy that this short seller made about them, because I think they did make some good points, but overall, the company continues to grow. When are they going to have an earnings? Earnings are going to start in 2 weeks, so it's going to get really, really busy. Their next earnings is going to be August 6th, so we're basically about a month and a week away, and we'll see their next earnings. We'll see if that, that story that they're advertising incorrectly is true. If their revenue grows another 40, 45%, the fundamentals are telling me the market doesn't care. Customers really like the software. That was all smoke and no fire, that story. But if, let's say, revenue only grew 25%, this stock's going to crash because the market's going to be like, okay, that story was true. So AppLovin, I think, for me, it's not a buy. If I own the stock, I'd probably be holding it, but I don't see the stock moving any higher for now. Year to date's 3%, so you're not losing any money, but you're not keeping up with like the Metas and especially like the Palantirs and stuff. The stock's just kind of sitting there. That's not a bad place to watch a stock. Go earnings or maybe 2 earnings, and then make a decision. This is a quality business. They have good margins. I would just like to see a nice discount. The market can give me this stock at $200 a share, $250 a share. That'd be great, so long as the fundamentals continue to be as good as they are. So thanks to asking about AppLovin, Saeed. And you have a copy. Since you're a member, you can go anytime and kind of study the research I did on AppLovin. So remember that part. Adam, good to see you. Love the homework and commentary. Thanks, man. I appreciate that. Nitchix, it's been a little while, buddy. Good to see you. All right, guys. Well, let me start to land the plane here. I love talking about stocks, especially on weeks when a lot of money was made. It's just a fun time. So on energy, let me think about that one. Maybe I'll address that one on the next live stream. All right, guys. So let me go ahead and land the plane on the live stream. I'm going to try to stream over the weekend. I'm not sure what times I'm going to be available, but I'm going to lock in my schedule and then I'll let you guys know. I'll post it on the channel. Please consider being a paid member. It'd be really cool to see some of these names that I've seen on streams for a long time and get you into the Discord, get you to collaborate with the rest of the investors. You want to get signed up? It's easy. Just go to the homepage. You click the join button and you're off to the races. You can pick the level that you'd like to be a part of. You'll get invited to member calls. You'll get access to tools, including the research page of all my valuations that I do. There's a couple hundred in there, companies all over the place that we cover. And you'll also get invited to the Discord. So overall, I think it's a really, really good option. We have a really good number of quality investors, so you can get access to that community. So consider it. It'd be great to have you. And when you come on live streams, you can put a stock ticker out there. I'll research it on the fly, which is, if you're not a member, it costs $5 in the super chat in order for a stock ticker to be evaluated. So take a look at it. It'd be great to have some more members, and especially some of those guys that have been around and coming to the live stream for a while. You have a lot to offer, and I'd love to get you into the community for you to collaborate, get value, and also contribute value in the discussion. So that's it, folks. You guys have a great weekend, and let's get back into it. We have one more trading day in June on Monday, and then we'll start the month of July and start the second half of 2025. Earnings coming up in 2 weeks. It is going to be hot and heavy in 2 weeks, man. We're going to have earnings every day for like 3-4 weeks. And we will stream. I'll stream during those times. We'll have a lot to talk about. So everybody, have a good night. Thanks so much for tuning in. I really appreciate it.